Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, 26th of February, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone. We're going to go through our slightly different run through that we do normally in the week. So for the Monday, we're going to go for our Monday run through, which is what I like to take a look at the shape of the week. What are the major macroeconomic, fundamental, geopolitical, central bank data events that are going to impact the financial markets, not just for today, but going into the week? Why do we do that? Even though we're day trading at trade day, because depending on whether we are expectation of more volatility towards different parts of the week, and it can impact how we're looking at markets today. So if we're expecting more volatility maybe in the second half of the week because we have a heavy data load or central bank events, etc., or there's geopolitical risk maybe later in the week, then maybe earlier in the week it's going to be a little bit more of a mean reversion day. What do I mean by mean reversion? Reverting to the mean, reverting to the average, more of a consolidation, range, chop, whatever you want to call it, okay, sideways. Could be more like that if we're expecting more towards the end of the week, more of a mean reversion rather than trending, okay? Also, you could see potentially more or less volatility depending if there's an anticipation of events coming up, yeah? So more volatility might mean that you change your approach to the market with respect to how bigger ranges you're expecting, how bigger breakouts you might be expecting, where you place your targets, where you place your stop losses. You might adjust those because of expectations. Okay, so for all those reasons, I think it's very useful to take a look. I've done this since I've been in financial markets for well over 30 years now. Take a look at the week ahead. I usually do it over the weekend. What is coming up for the coming week, how it's going to shape up the week. So we do put out these two fundamental macroeconomic fundamental reports at the weekend. You can get them. I usually post them in the forum as well. They should be uploaded into the Discord as well. You'll also see them in the public site, the tradeday.com site, and in the not only in the forums, but then they're also posted below where you're watching right now. There's three sections: technical analysis reports, fundamental reports, and then there's the live school news reports. Where in that middle section, fundamental reports, that's where you'll find the Trade Day Macro Matters report, which is the more in-depth report. I'm not going to go for all of this, but you can see more in-depth explaining everything that's looking back, everything that's been important for the past week, and then what we've got coming up going into this week, what's important. And then we have the condensed version of that, the weekly recap and update. Okay, so we're going to run through that right now. So what was important last week? Well, really, it was all about NVIDIA. Last week, the market dipped lower, was pulled down originally by NVIDIA, pre-NVIDIA results, as the markets did some, kind of almost like it was like buy the rumor, sell the fact before the fact. So it's buy the rumor, sell the pre-fact of just some position squaring ahead of NVIDIA. NVIDIA went lower ahead of its results and pulled the broader market down, pulled tech down, pulled the broader market down, pulled the NASDAQ down and the broader market with it. And then we saw a dramatic turnaround and a surge back higher across the indices as NVIDIA put in some stellar results and pushed higher. That was on the same day as then Fed minutes indicated that the Fed are pushing back on early rate cuts, and various Fed speakers through the week last week reinforcing that view that we got from the Fed minutes that the Fed are in no rush to cut interest rates. So we've gone from potentially. We were at the beginning of this year, certainly the end of last year, beginning of this year, December, January, after the Fed pivot meeting back in December, we were potentially looking at March for the first rate cut. We completely rejected March. Then we were looking for May for the first rate cut. And now the Fed have pushed even further back, and now we're looking at June. The market was pricing in 6 rate cuts this year. Now the market's only pricing in 4 rate cuts this year, closer in line with the Fed, which have basically told us they're going to probably do about 3 rate cuts this year. So the market has had a massive shift, and notwithstanding that shift to effectively the market has shifted to adopt the Fed's policy, which is not as dovish, so de facto more hawkish. So the Fed was more hawkish than the market was, or you could say the market got overly dovish, right? But the market has shifted to more hawkish, and even though it's done that, so yields have gone higher over the last few weeks, the last few months and weeks in here, and even last week as well. And despite all that high yields, all of that should be negative for stock indices. Stock indices continue to go higher, make new highs. The bull theme is very much intact, and Nvidia epitomizes that, and we're looking for more on the upside. That's my view as well. We've got more to come yet, and these first four paragraphs talking all about that. Flash PMI data. We've got final PMI data coming up this day. But the flash PMI, that's the early data that we get. We got that last week, and that was mixed. In here, the US data actually beat expectations. UK, European, disappointed and was slightly mixed, but generally, US data was slightly better on the flash PMI data that we got last week. So, what was the net result for markets? Well, global equity markets were up. In Japan, remember the Nikkei also doing very, very, very well, and we're seeing slight rebounds as well in China stocks, which have been underperforming so far this year. I fully anticipate China to turn around, of China to do quite well as we go through this year, but at the moment, China have been underperforming, but they started to turn around. Japan made a new all-time high, the first time since 1989. Now, that's a long time for even me, and for many of you, no doubt, before you were born. So since 1989, we saw Japan, the Nikkei, hit its new all-time high, the first time since then. Yields continue to move higher in the US and Europe. The US dollar went to a new multi-month high, but then retraced lower towards the end of the week. Gold futures moved back to the middle of their wider range, and oil futures went up to the upper end of their broader range, but then sold off on Friday. What have we got coming this week? Well, very, very quiet. We're looking at Fed speakers as ever. The only major or significant, not even that major really, but significant central bank in play is the Reserve Bank of New Zealand interest rate decision that we get on Wednesday. And then the main focus of this week, if you look at the US, the main US focus is going to be durable goods and consumer confidence data. So we get the US durable goods consumer confidence data tomorrow on Tuesday. And then the real focus, we get GDP, which is not usually a significant impact on markets because it's very backward looking, but the PCE data quarter on quarter. But more importantly from the US, here on Thursday, the US PCE month-on-month, year-on-year data. That's the big data for the week, really, from the US. We also get US Michigan consumer confidence. But really, the big data for the week, the US PCE month-on-month, year-on-year data. This is, remember, is the Fed's preferred measure of inflation. We also get global manufacturing PMI, the actual official numbers in here. And we get the ISM number. It's the 1st of March. Even though it's the first of the month on Friday, normally the first Friday of the month is the US employment report. We don't get it. When it falls on the first, though, the actual first of the month, we often don't get the employment report because they haven't had time to collate the data. So often, if the first Friday of the month is the first, which is the beginning of March, then we don't get the employment report. So we're going to get the employment report. The US employment report is not the first Friday; it's the second Friday of the month. So it's next week on the 8th of March. So we're not getting it till then. So the big focus of the week, really, that US PCE data. We get the month-on-month, year-on-year data, not the quarter-on-quarter data from Wednesday, the month-on-month, year-on-year data, and then the global manufacturing. So if we had to look at the week and where the skew of the data on the week is for the US, it's certainly in the second half of the week. We do see some important data as well, though. We do get further CPI data. We get CPI data from Germany on Thursday, and also EU CPI unemployment data on Friday. So again, the big European data, German retail sales, unemployment, and CPI all on Thursday. So even the European data is skewed excuse me, to the second half of this week. You can see nothing of note coming out today. We've got Japan CPI, but that's not really going to be a big impact in the US durable goods consumer confidence on Tuesday. So relatively speaking, the first half of the week, relatively light on data. Second half of the week, Thursday, Friday is where the heavy data, where the heavy lifting is being done. So potentially for a bit more of a consolidation, rangy kind of take a pause. And that's how the week started off so far in Asia and Europe. Consolidation themes going on rather than big bullish extensions of the bull theme. I'm still bullish. Where do I want to play it from? I want to play it from the bull side, from the long side. Is it going to be a big push higher beginning this week? Potentially not. Maybe the durable goods consumer confidence data could give us a push higher, but I'm thinking we're going to get more of a consolidation, mean reversion type activity, more of a chop, more of a range environment, not big ranges in here for the first half of the week, and then potentially we'll see how the data plays out, but we could see the bullish extensions, or maybe we get the correction lower into the second half of the week. Just going to the live school news. Remember, this is in that third column below where you're watching this. If you're watching this live live now in here. So we had some bit of European data this morning, but nothing really of great note coming out so far this morning on the US briefing. And if we go to 5 things to start your day from Bloomberg, so data dump saying that we've got a load of data this week. Well, we do, but it's not really top line data. Again, there's top of the agenda, the PCE data. I've already highlighted that. The Federal Reserve's preferred metric for inflation. We'll be watching that. Also in here, the data looking at the Treasury market too in here and how the Treasury market plays out. Remember, yields have gone to multi-month highs in here on yields. We did get a retracement to lower yields on Friday, but generally speaking, yields have been pushing higher. So we're going to see how that plays out. Cash pile, new record of 167 billion at Berkshire Hathaway. Doesn't really impact what we're looking at though. Room for stock markets to extend the gains before record highs. That's Goldman's view in here. My view, I've been very, very bullish in here and remain bullish. And sort of JP Morgan, though, saying that profit margins could be peaking in here. And that's talking about the data that we have coming up. Nothing really of note today. Stocks take a breather at the start of a data-rich week. We've already mentioned this. Preferred measure inflation due Thursday. Goldman Sachs is key for stocks to rally. We've already covered that. And in here, again, from Reuters, morning bid markets brace for inflation trifecta. What are the 3 we're looking at? Well, we already mentioned these as well. The PCE data from the US, European and Japanese CPI data that we have also this week. If we look at what the markets are doing on the actually, I'm gonna bump that one down here for a second. We'll come back to that at the moment. But yields in here, we've already gone through this at length in here. So sorry, the CME Fed Watch tool, no chance really of a rate cut here. Is the March. In May now, still sitting up at nearly 80%, just under 80% chance that we're unchanged in May as well. Now, June, very much the favourite, but still a 35% chance we don't get a rate cut in June in here. And we're looking then by the end of the year for rates to be now, look, so not even now favourite now at 4 rate cuts. Now the favourite 450 to 475. That's only 3 rate cuts now is where the favourite is. And that's what the Fed have told us. And the market is now completely gone to match the Fed. I think we had a massive swing. We said this would happen. If you look at the TV interviews that I from the beginning of the year, I said the first part of the year was going to be about the market and the Fed coming closer together, with probably the market moving towards the Fed. I think now we've had a big swing now. The market has come back in line with the Fed. Don't fight the Fed, as they say. I wouldn't be surprised if we see this now shift back the other way, that Fed speakers have kind of done their job. They've pulled the market back from its exuberance from December. And now we might actually see this column begin to rise, that we could get the risk of 4 rate cuts before the end of the year. And the Fed might start to guide us that way, that they're maybe when they start cutting rates from June, 1, 2, 3, 4, 5. We've got 1, 2, 3, 4, 5 meetings, okay? So the market's now pricing in only 3 rate cuts. We could go back towards 4. Obviously, at the end of the year, you've got the whole thing around the election, and they don't tend to. What the actual date is the election in here? Does anyone know that off the top of their head? November the 5th. There we go. November the 5th. Now, it's interesting, actually. It's November the 5th because if we go back in here, you see the Fed meetings in November the 7th. So they could cut those last 2 of the week of the year, okay? Because then the November the 7th may be a bit of a dodgy one. The 18th of September is far enough ahead of the election, so they're kind of not, they don't like to be seen meddling with the election. The November 7th one is probably too close to the election, because if they cut rates there, whoever wins, comes out as the victor on November the 5th in here, there could be an element of, well, you know what, it's kind of like saying that, the rate cut is coming because they won, right? So they'll probably, if we go and look at what we're pricing in now, 18th of September, 475, 450. And then if we go in here, oh no, so the market is pricing in a rate cut, potentially between those dates, between the 18th. So on this for November 7th, it is pricing in a rate cut for November 7th potentially. So but that'd be interesting. But we'll take a look at, that's a long, long way away, and we can see what's happening when we get closer to that. But what else we got in here for you? So kind of mixing here out of Asia this morning. The Nikkei up 0.3. The Hang Seng has been down 0.5%. Europe very much quiet in here, really. 0.3 down on the French CAC and the UK FTSE, with the German DAX pretty much unchanged in here this morning. And if we go take a look at the US on the overnights in here, pretty much unchanged. We've got pretty much a tenth down in here and less than a tenth down on the Nasdaq. So market's just sitting there, biding their time as we go into the beginning of this week. Quick nod to the charts. No reason to not be bullish in here going into today, but maybe a bit more of a consolidation day. But my underlying theme remains bullish in here as we get up to making new highs on the major indices in here. As I was saying before, despite pushing to the upper end to higher yields in here again last week, we did get a big pullback lower in yields, and again in here this morning. This could help stock indices higher. Maybe if we get a slight correction on the downside in yields, so lower yields can often help. So lower yields, higher bond prices can help the stock indices higher. But we do remain relatively negative overall in here on the bond markets, despite that pop back higher in here that we saw on Friday, higher in price, that's lower in yield. But if you look at the charts, yes, we had those kind of little failure sessions here on Friday. So look, that's a shooting star candlestick on Friday in here on the ES, on the S&P and the Nasdaq. Similar failure candlestick, having hit a new intraday high. But the underlying things, unless we get a significant push lower in here, the underlying theme remains bullish. So I think the adding up of basically Friday's failure candlesticks in here and then the underlying bullish tone means and even more reinforces a consolidation for today, particularly with no US data, particularly with the bigger data from Europe and US in the second half of the week. I think today's going to be very much a consolidation chop sideways kind of theme on Monday. All right, guys, I'm going to leave it there. I'm going to wrap it up. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you on Tuesday for another Bull versus Bear webinar.